Okay, so the first thing I want to do is just welcome you to Accounting 2302. So here in Accounting 2302, we're going to be dealing with the other side of accounting. So in 2301, we first talked about financial accounting. We dealt with all these rules related to US GAAP. And so we talked about a lot of things in a very structured environment in a way that was very specific because of how the accounting rules in the United States are. But in this course, we're going to have a little bit more flexibility, and we'll see that here in just a minute when we really dig into the differences between financial and managerial accounting. Who are we trying to provide good information to, and what is the overall purpose? And I think we'll see that there are some pretty significant differences in the two. So with that, I want to go ahead and start here in chapter 14. So here in chapter 14, the first thing we just want to talk about is what is managerial accounting? What are we really trying to accomplish? So the first thing here is that managerial accounting will provide us with financial and non-financial information for the managers of an organization and other decision makers. So you'll notice a key change here from what we talked about in 2301 is who we are trying to provide this information to. In 2301, we were primarily concerned with providing this information to those external from the organization. So investors, shareholders, bondholders, lenders of other types. That is who we were primarily concerned about. But in this course, we don't care as much about those individuals or those groups of people because here we're looking internally to the organization. So how does my internal management make decisions in the best interest of the company? So that's really what we're going to be looking at here. So the goal here is really threefold. So what are we trying to do? So with our managerial accounting, we're really trying to do two main things. We try to deal with planning and control. So when we're talking about planning, it's a couple of examples here. We got three. Certainly there are more. This is by no means an inclusive list, but this is where management might be asking things like, are there new products we can develop? What should we be doing for our customers? Are new markets a possibility? So maybe right now we're only operating in one city or one state. Maybe we should be able to expand that. And so we want to do some market analysis type of studies. We might need to build a new factory to amp up production. Any kind of thing like that typically falls under this planning category. The next area then is control. With control, we're asking the questions, are our costs too high? Are we selling this at the right price? Are we being profitable with the services or products we are providing? And finally, the last example here, although once again not an inclusive list, is are our customers satisfied? Because if our customers aren't satisfied, then we're going to start losing customers, and that's going to end up catching up with us sooner than later. So we certainly want to keep that in mind. Now, this is perhaps one of the most important items in this whole chapter, at least for this first exam, because this is where we really understand the differences between the course you've already had and the course you're about to take. So this is where we're going to kind of get our feet wet and start seeing some differences, and hopefully that'll help us understand why we do certain things in this course the way that we do them, when in the previous course we talked about perhaps doing them in a different way. So the very first thing we've talked about a little bit already, which is who is using the information. So under financial accounting, which of course that whole column references Accounting 2301, which is the previous course, in that course we said that we were primarily concerned with the external users of the financial statements. This was investors, creditors, lenders, and others outside of the organization's actual management team. But in managerial accounting, we're primarily concerned, notice, with the internal users of the financial statements. This is managers and employees, decision makers, etc., inside the organization, so that we know exactly who we are providing this information to. Now, notice the purpose of the information for financial was to help those external users make investment credit and other decisions related to doing business with our company. So it was very important that we had this very structured setup, and everything that we went through there was tied in with point number 3 here, which is very structured and controlled by US GAAP. But you'll notice points 2 and 3 are completely different under managerial accounting. Here, we're not dealing with those external to the organization. We're dealing with those inside the organization. And because of that, we're not publishing this information externally, so it doesn't have to go under what is called a year-end audit that we talked about in 2301. It is instead just used day-to-day in a day-to-day fashion for us to make good decisions internally. Because of that, we get away from this structured US GAAP set up quite a bit in this course, and we're able to do things that you certainly wouldn't be allowed to do in a financial situation. So we certainly see this major difference as we start to move away from US GAAP, which of course are those generally accepted accounting principles we talk about a lot in the first course. Now, here for our fourth point, we see that with financial accounting, this information tends to only be available after an audit has actually been completed. Whereas in managerial accounting, we tend to have this information available daily, hourly, however often we need it, so that we can be making good, quick decisions. The time dimension, of course, with financial accounting, it tells us what has already happened. So it is primarily concerned with the past. So we can use that past information to do things like trend analysis and start to make some limited projections. But the primary purpose of financial accounting is simply to record what has already happened. In managerial accounting, though, we're planning primarily. So what we're trying to do is make decisions for the future. So it is primarily concerned with those future decisions. So we see a lot more projections, we see a lot more estimates, and we will still make use of some historical or some past information. Now you'll notice in financial accounting, when we look at the focus of the information, it is on the entire organization. So it is not just one piece of that organization, it is the entire organization itself. With managerial accounting, however, we tend to look at one department, one level of the company. So, for example, if we were looking at Walmart, we might look at the produce section of Walmart. Then we might look at the apparel section of Walmart. But we would be able to very easily see what was happening in each different area of the company. Whereas in financial accounting, you would really just see a picture of Walmart as the whole. And finally, both of these are primarily based around monetary information, while managerial accounting does tend to focus a little bit on non-monetary items. So certainly some things you want to be aware of. Now, just as we talked a lot in chapter 1 in the previous course about fraud and ethics, we're going to talk about it again here because it is still very important that our accountants be ethical. So we want to make sure we understand that. Now, there is a study from 2016 from the Association of Certified Fraud Examiners, the ACFE. This is not an abbreviation that I'm going to be requiring you to know. This is probably the only time we'll talk about that organization all semester. But what they found is that they estimate that U.S. businesses lose on average 5% of their annual revenue due to fraud. So companies don't typically take this lying down. So what tends to happen is companies will inflate their prices between 5 and 10% to help offset some of these losses due to fraud. What that means then is if we could get people to simply be more honest and stop committing these fraudulent acts, then we might could actually see price reduction in stores for all of the stuff that we get on a day-to-day basis. Now, you say, well, how can a company prevent fraud? So this is where we talk about something called internal controls. You have heard about this. It is certainly covered in the previous course, but we'll rehash it very quickly here. An internal control system then is simply the policies and procedures that the company employs to do 4 main things. The first is to ensure reliable accounting. I think hopefully that makes some sense to us since you are taking an accounting class. This is hopefully going to help us have more accurate accounting records. It will then allow us to protect our assets, uphold company policy, and promote efficient operations. So just as we have codes of ethics for other accountants, the Institute of Management Accountants has issued their own code of ethics to help people whenever they run into questionable situations in accounting. I think when we hear ethics, a lot of times we tend to think very black and white situations. Should I commit fraud? Should I not commit fraud? And you tend to think these decisions could all be very simple. But in practice, particularly as you get into higher level accounting decisions, you'll start to see that the law and the rules are fairly gray in some of these areas. So it's very important to have this framework to help you make decisions whenever you do run into situations that maybe aren't common or maybe haven't even been dealt with by someone else before. So we certainly got to have a strong moral foundation, strong ethical foundation, so that we know that at the end of the day, we are making the decisions that are most appropriate. Now, this is an introductory class, so we are going to briefly talk about career paths, but I'll make this very short. Essentially, what you need to understand is Accounting 2301 is very important for the accountants. I think anyone who goes into business needs to have some information, some understanding of how financial statements work, and things of that nature. But truthfully, 2301 is less useful for those of you who are not pursuing an accounting degree or a profession directly in accounting. For those of you that are going into areas, marketing, management, anything like that, where you are hopefully going to be moving up and starting to make decisions, but you may not specifically be in that accounting area. I think this course, this 2302 course, is far more important because it is exactly what your actual internal management is doing on a day-to-day basis. So whether they know this is what they're doing, I think a lot of these ideas and concepts, whether they call them what we call them or not, are going to be getting employed because they simply need to be to run a successful business. So here we see marketing staff, of course, are going to need sales and cost data to determine which products to promote. Management will need Salesforce details to evaluate performance. Entrepreneurs, so if you want to go start your own business, you'll need to understand how costs work, how budgets work. You'll need to be able to build mock financial statements and actual financial statements to see if you hit your projections. All of this stuff is incredibly important, and all of this is actually going to be getting used by those people. So this is the more widely used course, and for that reason, I think it is the more helpful course for those of you who are not pursuing a direct accounting degree. Now, thankfully, if you are pursuing a direct accounting degree or something of that nature, there was a recent study a couple of years ago that said that approximately, I believe, half of top-level executives at companies, so your CEOs, CFOs, all those people up in the C-suite, about half of them have their CPA license. So your CPA license, of course, is a certified public accountant. This is what you get if you go into public accounting and you actually pursue the designation and you achieve it, which means if you go into accounting, you've got a pretty good shot at winding up somewhere at the top if that's something you desire and if you're willing to put in the work for it. Now, of course, what that means is the other half don't have a CPA license. So certainly I'm not telling you you can't be successful, you can't rise to that level without it, but it is certainly an advantage to have that. And more companies are requiring this CPA license for that highest level of management because they think that the CPA license designates a certain level of intelligence, a certain level of understanding as in relation to the accounting requirements of the business and all the ethics that go along with that. So it is a very high standard, and it is something you certainly want to pursue if you are going into accounting for sure. So just looking at these salaries here, I'd say these are fairly accurate from what I've seen in my experience and from talking to people that I know. Coming in right out of college, right around $60,000 is pretty normal if you've got a master's degree in accounting, and then you're moving up to whatever you advance to in your career. Certainly, where you go will have an impact on this. Smaller markets, you might receive a little bit less, but typically cost of living might be a little bit lower. If you go to a big city, Los Angeles, New York, Houston, you might have a little bit higher cost of living, but your pay will certainly be a little bit higher as well. So typically, it will certainly depend on where you end up, but this is kind of the way that this works out. So certainly a lot of career paths available to you, anything ranging from just a basic staff accountant up to division controllers and management, and then finally, of course, CEO, CFO, treasurer, things of that nature for your companies. So certainly lots of options. Now, in this course, one of the main topics that we need to cover first is this broad idea of cost classification. So we'll spend a little bit of time here. The very first type of cost classification that we want to talk about is fixed costs versus variable costs. So this simply refers to how a cost changes with changes in volume or changes in production level. So here's our graphs. We see this top one talks about fixed costs. You will notice that in total, your fixed costs are the same. So your cost is at a certain level, and all the way across that activity, you're spending the same amount in total. Now, this is true, although it is an oversimplification, perhaps, and we'll see this later in the course when we talk about something called a step fixed cost. So the way this works is from point zero until a certain level, your fixed costs remain the same. But at some point, when you need to expand your operations, you need a new building, you need a new factory, you need more equipment, whatever the case is, then your fixed costs will actually jump by an entire step up to a new level, say here, and they will remain there until your production needs hit a certain level, and then you need to increase again. So that is what is called a step fixed cost, and we'll talk about it later, but the idea here is a fixed cost is fixed as long as changes in production are not what is changing the cost. So this includes things like factory rent, factory depreciation, assuming straight line, things of that nature. Now, on the other hand, what we have here is total variable costs. And you'll notice total variable costs change in proportion to activity changes. So I want you to imagine we're producing bicycles for a second. If you want to produce one bicycle, of course, you will need 2 tires. If you want to produce 10 bicycles, you will need 20 tires. If you want to produce 100 bicycles, you will need 200 tires. So what we're assuming here is that each tire that you buy or that you produce costs the same amount as the tire before it. So here we start ignoring things like economies of scale and bulk purchase discounts and things of that nature to help simplify our lives. But certainly in real life, you might want to consider those items. So we've talked about these 2 types of costs in total, but how do they look on a per unit basis? So let's revisit our fixed costs for just a second. If you produce 1 unit and you have fixed costs of $10,000, how much fixed cost does that 1 unit have to cover? Well, that 1 unit will have to cover the full $10,000 in fixed costs. But if you start to produce more units, so the second you produce a second unit, now each unit only needs to cover $5,000 in fixed costs. Produce a third unit, each one needs to cover about $3,300. Produce a fourth one, each one needs to cover $2,500. So what you'll see with your fixed costs is that in total, they will actually be fixed, but on a per unit basis, they will come down at a decreasing rate. So you'll get something like this, right, that eventually becomes asymptotic to your x-axis. So what you're noticing, right, if this was a smooth line, would be that we have this pretty steep decline right away, and then it slowly starts to level out. Because as you produce more and more units, you're having to cover less and less fixed cost with each unit. So if you produce 1 unit, you have to cover 100%. But if you produce 10,000 units and your fixed costs are $10,000, you only need to cover $1 in fixed cost per unit. So in total, fixed costs are constant. But on a per unit basis, fixed costs decrease as production increases. Now, with your variable costs, you'll notice in total, we are saying that they are increasing, and notice the slope, right? It is constant. So we are saying that they are increasing at a constant rate, or that each individual unit has the same cost. So what you'll see is something like this on a per unit basis. So on a per unit basis, your variable costs are the same. So if the first tire costs you $5, the second tire costs you $5. The 10,000th tire costs you $5. But in total, right, your total cost for those variable items is increasing. So with 1 tire, your total cost is $5. With 10 tires, your total cost is $50. And so you see that coming through. So this is what we need to understand. We need to know both the in total effects of each type of cost and the per unit effects of each type of cost. But this is where we will leave this item for now. Okay. So once again, this is a very important distinction we're going to need to be able to make. Now, after we've talked about fixed and variable, we can then come to our next big cost classification, which is direct versus indirect costs. So when we are talking about a direct cost, this is a cost that is traceable to a single cost object. This means that this could be anything like material that is specifically used for the job. So I want you to think about the bike example again. How do you make tires? Well, you use rubber. So that rubber that is actually going into the tires is a direct material. Now, how do you build the frame? Well, you use steel perhaps. So that steel would be a direct material, a direct cost going straight into that bike. Because what we need to understand is these direct costs tend to be the very important things that I certainly want to know exactly how much went into each one of these items. This could also be the direct labor, so the people with their hands on the product actually putting it together. So this is your welder actually welding the frame together. This is the person installing the tires and the wheels and all of that stuff. Anyone with their hands on the product actually putting it together is what is called a direct cost. And so that would be a direct labor item if you were actually building it, a direct material if it actually goes into the product. Now, on the other hand, we have costs that are typically referred to as indirect costs. These are costs that cannot be traced to a single cost object, in this case, the bike. So this might be the glue to attach the handlebars. So do you need to know how much glue you're using to attach the handlebars for all of your bikes? Probably so, because you certainly don't want to be wasting it. But do you want to figure out that you use 6 drops of glue on this bike handle, and for each drop that costs 18 cents? Probably not, right? It's probably not a very efficient use of your time, because in order to even figure that out, you'd have to go dump one of your huge vats of glue, count how many individual drops of glue were in that vat, divide that into your total cost of that glue, and then that would give you a per drop rate. But good Lord, that seems incredibly inefficient. So I'm going to say probably don't go that way. Don't go that route. Instead, we'll just allocate that cost through at the end through one of our allocation methods that we'll talk about this semester. So this is an indirect cost. Is it still related to production? Sure. But do I want to trace exactly how much glue was used on each individual bike, or exactly which screw was used and how much that specific screw cost me? I probably don't care, right? We'll figure it all out at the end. So this also includes things like any maintenance expenditures that benefit multiple departments, and we'll actually deal with the allocation between what are called service departments later in the semester. So certainly something to keep an eye out for. Now, this is one of the most important formula-based slides in this course, truthfully, because it relates a lot of the topics that we've talked about so far. So what I want you to imagine, or what I want you to write down certainly, is that a product cost is related to production. Okay, so whenever you get confused and you can't remember what is what, I want you to remember you cannot spell production without product. So if it is related to producing the product, it is a production cost or a product cost. Okay, now, in addition to being called a product cost, this might be referred to as an inventoriable cost or a manufacturing cost. Okay, so all of those terms, product cost or production cost, inventoriable cost, and manufacturing cost, all mean the same thing. So if you hear me use any of those terms, or if a question uses any of those terms, I want you to know we're talking about the same thing. Okay. Now, you'll notice three main things make up our product cost: direct labor, hands on the actual product producing it; direct material, that rubber for the tires, that steel for the frame, all of that is a direct material. And you'll notice this last area here, manufacturing overhead. So if it is related to producing the product, but it is not direct labor or direct materials, it will fall into this broad category of manufacturing overhead. So let me ask you, you've got a production supervisor. They're walking around the factory. They're making sure everyone's got what they need. Everything's running correctly, but they aren't hands-on welding the frame together. They aren't the ones screwing in the screws or driving in the nails to whatever you're building, right? So if they aren't hands-on, could they be included in direct labor? And the answer, of course, is no, because the way you are included in direct labor is by actually doing the work. If you're just supervising, right, that is still important, but it is not direct labor. It would fall under this category of indirect labor, which runs through manufacturing overhead, and we'll see more of that in just a moment. Now, if you don't have a product cost, you have what is called a period cost. Now, period costs are expenses, but they are not attached to the product. So they are not involved in the direct production of the individual product your company tries to sell. So in this case, this is the bike manufacturer, right? Anything not specifically related to producing the bike would be called a period cost. So period costs break out into two main areas. We have selling costs that are incurred to obtain orders and deliver finished goods. So this could be things like advertising costs, this could be delivery costs, salesperson's commissions, salesperson travel expenses. Anything related to making the sale falls under selling costs. Anything not related to selling, right, tends to fall under general and admin. So this is pretty much everything else, but the key word here that we typically see is things like office. So if you see depreciation on office equipment, then we're looking here. If you see office expenses, if you see office salaries, that tends to be a general and admin type item. Certainly those lists are not all inclusive, and the book has more examples, but that'll give you at least an idea of what you're looking for. So if I were you, I might be asking the question right about now, why do I care if I've got a product cost or a period cost? Does it actually matter? What are the implications if I call one cost a product cost and it should have been a period cost, or the other way around? Is this actually an important distinction? And I want you to think back to 2301. In 2301, we prepared a lot of financial statements. Okay? So remember the four financial statements we prepared: the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. right? In that order. That was how we prepared them. And now I want you to think about what goes on each financial statement from 2301. 2301, we talked about that income statement, and we said basically two main things, revenues and expenses, go there. Toward the end of the semester, we started adding things like gains and losses, and we started thinking about other interesting items, but primarily we're thinking revenues and expenses. Okay? Then on our balance sheet, we said that was essentially the accounting equation, assets equals liabilities plus equity. That was our rule for the balance sheet. So where do you think a product cost, a manufacturing cost, that inventoriable cost, right? Where do you think that gets reported on your financial statements? Well, the way I want you to remember this is that inventory is an asset and assets go on the balance sheet. So when you hear the phrase inventoriable cost, I want you to think we're dealing with inventory and that cost goes to the balance sheet. So initially, that balance sheet is going to hold the cost of your inventory until it is what? Until it is sold. Once that inventory is sold, then it will move from the balance sheet through to the income statement. So you'll switch from having an asset to having an expense. And that is the way that we'll move that inventory off. So it's incredibly important that if it is an asset related item, if it is a product cost, that it be reported properly as an asset on the balance sheet at the beginning. But on the other hand, if you have something that is not an inventoriable cost, it is not a product cost, right? Then you are looking at something that goes to the income statement right now. Because of that, that will hit net income immediately instead of being deferred by sitting in inventory. This is going to be an incredibly important distinction as we walk through some different methodologies and costing ideas during the course, because it will explain why one method leads to one result, another method leads to another, and it'll help us understand what's actually occurring here. So remember, those product costs initially come through and sit on the balance sheet. They sit there until they are sold. Once they are sold, they leave and they go through to the income statement. But if you have a period cost, it never hits the balance sheet at all. It is not an asset, it is simply an expense, and it goes to the income statement right away. That is why it is so important to properly allocate between product costs and period costs, because it will help you make your financial statements actually correct. Now we see this coming through in this example. So you'll see here we've got our costs incurred from the 2019 year. If we have a period cost, it runs straight through to the 2019 income statement. Your product costs all come down and they go to one of two places. If the inventory is sold in 2019, it will go to the 2019 income statement right away. Boom, there it is. But if it is not sold, then it is still an ending inventory. If it is still an ending inventory, it will be sitting on the balance sheet at the end of 2019. And then when sold in 2020, it will run through to the 2020 income statement. Certainly exactly what we talked about, but a very good graphical depiction here for that. Now, I'm just going to walk through one or two of these because we'll do plenty of these in class, but just so you can see how this works, we will talk about a couple of them. So the first one here we'll handle bicycle tires and wheels. To produce more bicycles, will you need more bicycle tires and wheels? Certainly you will. Because of that, that is a variable cost. So to produce one bike, I need 2 tires and 2 wheels. But to produce 10 bikes, I'll need 20 tires and 20 wheels. So in total, my cost will be increasing to ramp up production. So that is certainly a variable cost. Now, do you think you care which tires and wheels go on which bike? I would certainly hope so. So that is a direct cost. And is that related to actually producing the product? It certainly is. So you do have a product cost there. Now, we're going to skip down a little bit and we're going to look at the production manager's salary. I want you to notice a key word here. It is salary. When you see the word salary, I want you to think fixed. If you see the word wages, I want you to think variable. In this case, we are told we have a salary. That is a fixed cost. Now, is that a direct cost or an indirect cost? Well, your production supervisor isn't hands-on anything. They're simply making sure everything is working properly. So because of that, we have an indirect cost here. Now, you say, well, is that still a product cost? And I would say absolutely it is. This is specifically what we call indirect labor. Remember, if it is related to the production of the product, but it is not direct materials or direct labor, it is part of manufacturing overhead. And remember, product cost is equal to direct materials plus direct labor plus manufacturing overhead. So we certainly would call that one a product cost as well. Now, the next two I want to look at here are the 2 depreciation items, and then we'll move on. I want you to notice factory depreciation and office depreciation look very similar. Notice how they are both fixed, they are both indirect. So why then is one a period cost and one is a product cost? Is it a typo? Is the textbook making a mistake here? What has happened? Or why might this be correct? So let's think. That key word there is office depreciation. So is the key here the word office or the word depreciation? Well, if you look at the next row, you see factory depreciation, and you notice it was treated differently. So the key word can't be depreciation. The key must be what then is being depreciated. So in this case, we have office depreciation. Are the people in your office the ones putting together the bike? So is that machinery that is inside the office, say for example, your accountant's computer, is it the one welding the bike together? Is it the one putting the pieces onto the bike? And the answer is certainly no. So because of that, it is not related to the production of the product. It cannot be a product cost. It must then be a period cost that goes right through the income statement right away. On the other hand, that next one, factory depreciation. Well, factory depreciation, that factory is certainly involved with the production of your product. So because of that, what you have here is a product cost, because without those factory machines, you would be unable to produce your bicycles. So it is certainly a product cost. Okay. Now, I'm not going to spend a lot of time here about service companies, but certainly these types of ideas can be applied for your service companies as well. So they say here, for example, the cost of beverages for passengers of Southwest is a variable cost, because if you have one passenger on the plane, right, incredibly unlikely they're going to fly a plane with only one person, but in the event they did, they would have a very small variable cost, right? You only have one person. Even if they eat or drink a ton, there's no way they're going to be able to eat or drink as much as 400 people on a flight. So what you see here then are 200 people, however many people fit on those giant airplanes. So what you see then is as you ramp up the number of people you're putting on that flight, so too the cost of the drinks and beverages and food items is certainly going to be increasing as well. Now, here we're going to talk about some of the items we've already talked about. So direct materials, once again, be something like the steel used in the frame of a bicycle. Direct labor would be the people who are actually assembling the bike, the people actually doing the welding, putting the tires on, things of that nature. Factory overhead then is going to be all of that miscellaneous stuff that is still related to production. This could be your maintenance workers. You come in and make sure all of your machines are oiled up and greased up where they're actually working correctly. This could be them tightening stuff and loosening stuff and honing in the manufacturing parameters so that you're getting exactly what you want. But anything like that is certainly related to production, because if your machinery is not well taken care of and well maintained, I don't think you're going to be very successful in producing your product. So while it is not direct, right, while I'm not going to allocate directly the amount of time that you spent working on this big machine to each individual bike, it is still related to the production process, so it will still run through as a product cost. Next, we see indirect material. Indirect material could be something like cleaning supplies, once again for a very similar reason to the maintenance. Without a clean area to work in, you're going to not be able to produce your product very efficiently, so it is certainly related to production. Things like factory utility costs and supervisory costs are all part of factory overhead as well. Now, here are two very important formulas, certainly for this chapter, but even for future chapters. So you will certainly want to write this one down. The first of these is what is called prime cost. This is simply the sum of direct materials and direct labor. The next is what is called conversion cost, which is simply the sum of direct labor and manufacturing overhead. It is very common on this exam for me to ask you how to calculate both of those items for one set of data. The most common mistake I see is people will calculate whichever one I ask for first beautifully, and then they will butcher the second one because they will simply add the missing item. Well, of course, they include different things. So trying to take this shortcut results in a missed answer. Instead, take the extra 10 seconds, rewrite out the formula, make sure you plug in the right numbers, and you'll get your points very easily. So do make sure you don't fall into that trap. Now, we've talked a lot then about our manufacturing costs or our production costs, and now we're going to talk about our non-manufacturing costs. These are simply recorded as expenses on the income statement when incurred. These are a period cost. This includes things like your selling, general, and admin expenses. And notice they are not part of factory overhead. Why? Because they are not incurred in the manufacturing of the product. Now, a couple of just broad differences here between your merchandisers and manufacturers. merchandisers buy and sell finished goods, while manufacturers buy the raw materials and then produce the finished goods and, of course, sell those. So with a manufacturer's balance sheet, you tend to see a little bit more detail than you might on a merchandiser's balance sheet. So what you'll see here is things like raw materials inventory, work in process inventory, and finished goods inventory. So we don't simply have inventory anymore like we did in 2301. And that's because we've got inventory at different stages in the process. So when I first buy the rubber, I don't yet have tires. All I have is rubber. So it's not the same thing. I might want to know where that's at. So when I first buy the rubber that I'm going to use to produce the tires, is sitting over here in raw materials inventory. As I start to put that rubber into production to actually get completed into an actual tire, it'll be in work in process inventory. And once that tire is complete and able to be put onto the bike, at the time that the bike is all put together, this will all move through to finished goods inventory. So that is, of course, the way that works. Notice here, you've got your balance sheets for 3 different companies. You've got a service provider, and notice they don't have inventory at all. This could be an accounting firm, for example, or in this case, this is an airline. So what you see then is you can't pick a flight off a shelf and walk out with it. So there is no inventory for an airline. There is no inventory for an accounting firm that's preparing your tax return, right? You don't walk in and pick someone else's tax return off the shelf and walk out and claim it as yours. So there's no ability to have inventory for these service providers in the normal sense that you would think of. With a merchandiser here, we see telemarts. This could be something like Walmart, but they're buying and selling finished goods inventory. So notice all they report is one type of inventory account. While with the Rocky Mountain Bike Company, we see that they are actually producing all of the material, or they buy the raw materials, put those into production, and then come out with a finished product. So instead of just saying merchandise inventory, which wouldn't be very helpful, we actually give you a breakdown. So you can see, well, we've got $9,000 worth of materials in raw materials inventory that are ready perhaps to be put into production but have not yet been. We've already got $7,500 currently going through the process and a little over $10,000 in inventory that's actually complete and ready to be sold. So this is a very important thing, because if you were trying to make a decision, you might certainly want to know where they're at. If they have no inventory ready for sale, that might lead you to make a different decision in getting involved with this company than if they already have all of their stuff ready to go. So certainly important information there. Now, the way that I would do this if I were you to understand these costs is just pick one. Pick one of these formulas and know it, and then you can apply it to the other side. They're very similar. So notice here, we'll tackle the merchandiser first. You start with whatever the merchandiser had in beginning inventory and add anything they purchased. You'll then subtract out anything left over, and that'll tell you what is left in, or what actually got sold. So start with what you have at the beginning of the period, add whatever you purchased, subtract out whatever you did not sell. Well, of course, what you then calculate is what you did sell, which is cost of goods sold. Now, on the other side of this, you got your manufacturer's information. So here you take beginning finished goods inventory plus what's called cost of goods manufactured. And there's a good long report that we'll get to prepare in just a moment called a cost of goods manufactured report, which will help us calculate that number. We'll then subtract out any ending finished goods inventory, and that will, of course, tell us what got sold. So you can look over this example if you want, but it pretty much just runs side by side, showing you the different terminology there. So next, I think this is a very good graph. I'm not going to spend a ton of time here, but certainly something you might want to look at if you're struggling with where these things roll through. So I'm just going to pull up the pen real quick, and we'll talk about it very briefly, but I don't want to spend too much time here. So notice you've got raw materials, beginning inventory, and the purchases. At this point, you've got a decision, right? If they were used, then they will run through to this direct materials used category. If they have remained unused, you will follow this straight down and you will land in raw materials ending inventory. In the event you have indirect materials, they will simply run through factory overhead. Now, in the next area, you got your production activity. So you got your work in process beginning inventory, plus your direct materials used, direct labor, and factory overhead. In the event the product is completed, it will run through to goods manufactured. In the event your product is incomplete, then these costs will run into what is called work in process ending inventory. Now, related to your sales, you'll have your finished goods beginning inventory plus your goods manufactured. In the event these items have gone unsold at the end of the period, you simply follow this line down and land an ending finished goods inventory. In the event the goods are actually sold, you'll follow the line down to your income statement in cost of goods sold. So that's the way that all of that works. I'm going to simply erase all of these lines so they don't follow through to the next slide with us, and we'll go ahead and move on. Okay. Now, here we go. Our schedule of cost of goods manufactured report. The basic formula for it looks something like this. And we'll get more involved as we have to calculate each one of these items, but certainly if you know the general format, it will help you figure out what all needs to be included where. So we start with our direct materials used. We'll then add in our direct labor and our factory overhead, which gives us our total manufacturing cost. At that point, we'll add in our beginning work in process and subtract out our ending work in process to figure out the cost of goods that were manufactured in the current period. Here we have an overview of this manufacturing statement. So you'll notice here the top section highlighted here is dealing simply with our direct materials. So we have our materials beginning, notice 12/31/18, but we're preparing this for 12/31/19. You say, well, is that a typo? Why are we referencing information from the previous year? This is a very common theme that we'll be seeing in this course, so I'm going to take a second to talk about it here. Notice here you have 12/31/18 and we're coming down to 12/31/19. So the reason for that, of course, is that what we see is whatever you ended the previous year with is what you will begin the current year with. So when you ended 12/31/18 with $8,000, you started January 1/19 with $8,000 in raw materials inventory. So that simply carries over. This is a common theme in this course, that ending becomes beginning in the next period. So it's important to point it out here. Now, we'll then add in our raw materials purchased for the period. That gives us what's called raw materials available for use. If you remember back in 2301, we talked about inventory a lot, and what we saw was this beautiful chart, and it said something like beginning inventory plus purchases equals goods available for sale. After that, it splits out into two broad categories again, and we said at this point, this is everything you could have sold. Now, you either sold it, and if you sold it, it went where? Well, it went to the income statement through cost of goods sold. And if you did not sell it, then it went nowhere. So it sits on the balance sheet in ending inventory. That's the same type of logic we're applying here. Notice this gives you raw materials available for use of $94,000, less the raw materials inventory. So what was not used was $9,000, which means what was used was a little over $85,000. So we do see that here. Now, on the next section, we see our direct labor. This tends to be everyone's favorite piece of this report because it is typically the most simple. In this case, it's simply one number, so $60,000 coming straight through. Factory overhead tends to be everyone's least favorite because there's a lot of stuff that falls in here. Now, remember the rule though, and it's not too bad. If it is related to production in any way, and it is not direct materials or direct labor, it is a factory overhead item. So this is things like indirect labor and factory supervision, utilities on the factory, because how can you produce your product without, for example, electricity? You can't. So you got to pay that utility bill, so it is part of factory overhead. Repairs on factory equipment, property taxes, notice, on the factory building. Because it is related to the factory, those property taxes are a factory overhead item, which is a product cost. We then see things like factory supplies used, and notice the key here. The one key is, of course, the word factory, but the other here is indirect materials, telling us that these items are related to production. Factory insurance that has expired, depreciation expense, notice factory assets, and amortization expense on patents, notice on that factory equipment. So with all of that told, then we see our total factory overhead. At this point, then we are able to calculate what is called our total manufacturing cost. So our total manufacturing cost then, of course, is the sum of direct materials, labor, and overhead. So 85 plus 60 is 145 plus 30 is 175. So here's where this 175 comes from. At that point, we'll add in any beginning work in process. Or whatever we ended the previous year with will be added. The plus 2,500 is 178, minus whatever we did not finish this year, $7,500. So we add what we began the year with because we assumed during the year it got finished. And if it didn't, it'll be included here when we back it out. So we'll back out that 7,500, giving us a total for cost of goods manufactured in the current period of just over $170,000. Once again, a pretty good chart here showing you how costs flow. We covered this already in the previous chart, though, so I'm going to skip over it for the sake of time. If you do have any questions, though, please feel free to come by my office and I'll walk you through it. Now, a couple of things here. We're talking about different trends in managerial accounting. The first being customer orientation. Pretty much, we want to give the customer what they want. We want to do it in a way that is the best for us. So we want to really try to find a win-win situation here. So with the customer orientation, what does the customer want and how can we give them that? With total quality management, we're looking at quality quality improvement being applied to our business activities. But really the idea here is we're never good enough, right? We're always trying to improve. So things we want to do are seek and uncover waste, encourage employees to try new methods to improve quality. So what this means is if you have an employee who is very good at automating things, very good at figuring out new ways to perform tasks, for example, in Excel or other items, you shouldn't discourage that because it's a new method, right? If it's a faster method, if it's a better method, it would be good to encourage that type of behavior so that you can increase the efficiency of the organization. Very often, though, we do get situations where people in upper management decide they want to see stuff done the same way it's been done for the last 25 years. And that's fine, but it could certainly lead to some inefficiencies along the way. So we want to be very careful not to do that and to encourage people to think outside the box and come up with new ways to get things done. Next, of course, we want to emphasize the value of quality through quality awards. So we might, give people a bonus or give them some type of plaque or something to commemorate that they've done a really good job on certain activities. Next, we see what is a very common theme now, and it's called just-in-time manufacturing. So the way this works is you don't do anything until you have an order for it. So you receive the customer's order. At that point, you schedule production. Then you set everything up so that you receive materials just in time to go into that production. You will then complete the parts just in time for the assembly. And finally, you will complete the product just in time to ship it to the customer. So you say, well, why on earth would you do this? Well, the good news is with this, if you can do it right, the goal, right, is to manage your inventory down to zero. So you have no need to store inventory. You have no need to pay any type of inventory carrying or float costs. So you can really cut down on the costs associated with maintaining inventory. Now, of course, what's the problem with this? Well, what if, for example, there's an international pandemic that disrupts supply lines and your customers need their products the same as they always have? Well, if you have no inventory to fall back on and you don't get your shipments right on time every time anymore, you may not be able to meet customers' demand. And in that case, what you may see happen is not only do you lose the current sales, but once they find a new supplier who can meet those needs even in bad times, they're very unlikely to come back to you. So you could actually end up losing future sales. And typically, customers talk, particularly now with the rise of all of these social media platforms, Facebook, Twitter, etc. What we see is companies getting a bad name very, very quickly and their reputation getting ruined very, very quickly if they're unable to meet customer needs. So it's a very risky business model. But it is certainly one that can work out really well if you have everything lined up just right, because it can dramatically cut your costs related to your inventory. Next, we want to look at what's called value chain analysis. We're really just trying to make sure that there's everything involved in this production process is actually adding value to the product and to our customer's experience. If we find something in here that is not actually useful, then we want to excise, I want to cut it out and remove that piece. Now, of course, lean models. Here, what we're talking about really is just trying to figure out ways to provide more accurate costing information in a way that is easy to understand to our users and to the accountants in general. So here we see managerial accounting, of course, has an important role in providing the accurate information related to costing and performance that the companies need to be successful. Now, the last area, I believe, in this little section is what's called corporate social responsibility. This is also called CSR. The idea here is maybe corporations shouldn't just be corporations anymore. So we think it would be a good thing if corporations were more involved in their communities and helped out with different things. I know when we had a lot of really bad hurricanes a couple of years ago, a lot of the accounting firms up around Houston shut down for several days or a week so that their employees could go out and actually help the community, get people's homes fixed up and all sorts of stuff. So certainly a good look for them, and certainly something that we would want to encourage companies to do, right? At the end of the day, while companies do need to be profitable to support themselves and to support their employees, if they can find a way to do that and still be good stewards of the community, that's certainly something we want to encourage. So what this does is it really gets off of this single bottom line, which whenever we think of just the first bottom line, we tend to think of net income on the income statement, which is a purely financial focus. It is important, certainly. It is the main responsibility of the company to be good stewards of the invested assets of its owners, and to generate a return for them. But beyond that, we also want them to look at things like social and environmental measures to try to be as responsible as they can. This is what is called a triple bottom line that focuses not only on the financial side, but also the social and environmental issues. So right here toward the end of the chapter, we talk about a couple of ratios. So the first one here is raw materials inventory turnover. This is simply raw materials used divided by average materials inventory. And at this point, you may say, well, how on earth do I calculate average materials inventory? And thankfully for us, they include that right below. This is beginning materials inventory plus ending divided by 2. The next one that we see here is days sales in raw materials inventory. This is ending raw materials inventory divided by raw materials used times 365. We'll see several days formulas throughout the course, and the way this typically works is whatever you are doing, you will then multiply by 365 anytime you see the word days. Okay, so that is the key there. And with that, we have reached the end of chapter 14. This is the end of your first chapter in this course, and we are off to the races as we proceed through. If you ever have any questions, please don't ever hesitate to reach out to me and contact me by email or come by my office. I'm always happy to meet with you and help you get caught up. But with that said, this will wrap up the first lecture. So thank you all very much. We'll see y'all in class. Thank you.